Hi everyone, and welcome to this week's Macro Outlook. This will be followed by some chart analysis I do in part two. So hopefully you'll watch both parts. Okay, let's take a look at what happened last week and Macro Outlook going forward. So, where do we start? I suppose really it's got to be with the markets reacting to central banks last week. Powell came out and said that they were still expecting 3 rate cuts this year, but that's despite sort of inflation just inching just that little bit higher again. Now, the interesting thing was the dot plot. This is where the Fed voting members, they give their expectations going forward over the next few years. And the one really to make note of was for next year, because they dropped from expecting 4 more cuts in 2025 to only 3. Now that would leave rates probably around about 3.75% to 4% by the end of 2025. I've got to admit though, I do expect 4 cuts next year, and possibly for the rates to even go as low as 3.5%. Now, the Bank of England also expect inflation to drop enough for them to begin cutting this year. Inflation is in the UK down to 2-year lows, and there's 2 more cuts in energy price caps due by the summer, and that could make inflation drop that little bit faster. Of course, the retail sales rose a little bit. Plus oil prices are steady. They've hit the highest level since October last year. They touched $83 last week. And then moving on, Bank of Japan finally joined the rest of the world, leaving negative rates behind with their first rate change in 17 years. And we should expect another small increase, likely before the year end, I would say. Probably the surprise of the week, though, was the Swiss. They beat their peers in cutting, 25 basis points, so their rates were already down to 1.5%. I don't think they really got that massive inflation boost that many other parts of the world did, but I'm not totally sure on that. So anyway, to be honest, I can't wait for the day that central banks fade into the background again and go back to their, in my mind, their real role, which is, creating stable employment and a stable currency, really, and a few other bits and pieces, rather than all this QE and QT that they've been doing. As I always say, doing QE is the easy solution. In my mind, it's not the best solution. But yet, gold made another new high, $2,225, before closing Friday around about 21.66. Stocks closed just off their record highs that were made on Thursday. The dollar finished the week strong, and the yuan dipped below the key level of 720 to the dollar. Just sort of a little bit of an idea of what's been going on so far this year. So we've got equities up over 30%, gold up almost 10%, crude up over 15%, cocoa up a huge 211%. That's all year on year. And then the ones that are lower. So we've got ags that are down 15 to 30%. That's agricultural products. Nat gas is down over 20%, and steel's down around 25%. So yeah, it's a little bit strange, some of those, to be honest. And then of course Apple dropped as regulators on both sides of the Atlantic are threatening large fines over their market dominance. Well, possibly the abuse of it anyway. Tesla cut production in China due to weaker demand and higher competition. Another highlight of the week was the Reddit IPO, which was a huge success with its share price jumping some 67% at one stage. However, that's great, but geopolitical situations remain tense, with Ukraine continuing to hit Russian oil refineries with drones. Of course, that's one of the reasons why oil had a strong week. Russia responded by striking at Ukraine's energy infrastructure in several regions and quite close to one of their nuclear reactors, I believe. Putin won a landslide re-election. Bit of a shock, isn't it, really? Or not? But then there was a shock because there was a mass shooting in Russia with over 100 killed or injured. You don't hear that very often. Now, Israel seems determined to complete their plan, and Rafah is the next phase, with America trying to offer an alternative to obviously prevent the destruction that's going to cause. Just going back to Russia for a moment, India refineries are refusing to accept Russian crude oil due to the US sanctions that were imposed on Russia. Those sanctions have been imposed for quite a while. And when we look at the US government, once again, just managed to narrowly avoid a partial shutdown. That gets so boring, doesn't it? The House passed a $1.2 trillion funding bill, although it's possible now that they're going to be looking for a new House Speaker very soon. Republicans won't be so happy. Okay, soft landing for the US remains very possible. Although, you've got to say that COVID cash must have run out by now. And of course, many are going to need to refinance probably over the next 18 months, and they're going to be at much higher rates. So again, disposable income savings could be draining for sure. And that's even if rates do start to drop, that they're still going to be paying a much higher rate if they've got to refinance. Other countries are sort of still risking a technical recession. However, at the moment it does seem doubtful that it will become anything more sinister. And with inflation lower, rates lower, or rates about to be lower, what's next to focus on? Job losses, debt levels, maybe they are the areas next. Otherwise, what do we look for? And of course, as we are heading into Easter, expect volumes to drop, which usually leads to an increase in volatility. Following Easter, we're going to start to get Q1 corporate reporting. Then we'll find out if their performance really merits their share price or not. Next week, amongst the data, we do have the Fed's favourite inflation metric, PCE, being released. Now, I will still be posting my YouTubes next weekend. And also, my new website is live now. So try and take a look at that. It's posted on the bottom there. You can see the link for that. So hope that you'll take a look at it. It's a great website. Got lots of information. Offer lots of services to help you guys. And the website has actually got a members only section as well, where there'll be lots of goodies plus my daily newsletter posted. So anyway, now I'm going to move on to the technical analysis, and hope you'll stay with me for that. Happy Easter, by the way. But now I just want to sort of just talk a little bit here about my services that I offer. So there's a daily newsletter that includes global news, headlines, my views, full articles. That is a subscription service. There's one-day workshops. This will help you to discover if trading could be your next career or even just a second income. Otherwise, maybe you're already trading, but there's a few gaps that you'd like to fill in, and I can help you with that, because that will accelerate your trading and your performance. And then there's a 1-week intensive course. That's going to make you feel competent and confident after just 1 week. It's going to give you those foundations that you need to build your trading career on. And you know, if you've got that in a trader, we'll find it. And now that does also include a free trading challenge. Then I do a Flexi Masterclass, which includes 6 weeks of guided learning. They can be split up, you know, you don't have to take them all at once. And this is designed to provide you with all the knowledge and trading tools that you're going to need to navigate any market and also on any asset class. You know, I trade them all. And as I say, you know, you can spread those weeks out over months if you need to. It's no problem for me. And again, that does include a free trading challenge. Now, trader mentoring, I'm doing more and more of this. And, you know, this is to help you reach that next level time and again. And, you know, I'm doing much more in the way of one-on-one sessions right across everything that I'm doing now rather than sort of looking for big groups. I do provide a lot of trader educational content to individuals, exchanges and brokers. And as you know, as I mentioned earlier about the trading challenges, you know, if you're looking for a funded trading account, then you know you can contact me for details just about the ones that I use, or you know you can sort of take one of the courses where I'll give it to you for free at the end of it. Okay, so then moving on to our disclaimer, just to make you aware that trading does involve the potential risk of loss of capital and is not suitable for everyone, although hopefully it is for you. And many companies provide leverage, so just be aware that you can lose substantially more than that initial investment. Everything I include in here is just purely for educational purposes. I'm not trying to encourage you to trade or invest. That must be your decision. And of course, you know, before you make that decision, you've got to consider the risks involved, definitely your financial situation, your level of experience, and your risk appetite. And of course, it's important that you only risk capital that you're prepared, but also that you can afford to lose. And if you've got any doubts whatsoever, seek independent financial advice and do that before you risk your capital. So many people come and find me after they lost money, which is sad. You know, they should come to me before. And yeah, so listen, that's it for part one. I hope to see you in part two, where I'm going to do some technical analysis.